Before money, before banks, and long before the first human economy, there was gold. The atoms inside a gold ring were forged in violent cosmic events, exploding stars and collisions between neutron stars. Some of that material became part of the young Earth, while later asteroid impacts may have added more gold near the planet's surface. Gold was rare, but rarity alone did not make it money. It also resisted corrosion, could be shaped without breaking, and kept its color for generations. A gold object found in an ancient tomb can still shine today. That physical permanence gave gold an emotional quality. It appeared untouched by time. Yet gold has almost no direct survival value. You cannot eat it, drink it, or build a civilization from it alone. Its power came from a human decision. Across cultures and centuries, people agreed that this strange, durable metal was worth keeping. Money begins with a problem of exchange. In a barter economy, a farmer with grain must find someone who wants grain and also owns exactly what the farmer needs. Cattle can carry value, but cannot be divided cleanly. Salt and barley are useful, but they spoil, vary in quality, and are expensive to transport. Societies gradually selected objects that were durable, portable, recognizable, divisible, and difficult to reproduce. Gold and silver fit those requirements unusually well. Their most important property, however, was collective belief. A gold coin worked because the seller believed another person would accept it tomorrow. Money was never only an object. It was a network of expectations. The larger the network, the more useful the money became. This is the central paradox of currency. It can coordinate millions of strangers, but only while those strangers continue to trust the same symbol. Gold solved many problems, but created another. It was heavy, risky to move, and difficult to use for large transactions across long distances. Merchants began depositing metal with trusted vault keepers and banks. In return, they received paper claims, receipts promising that the bearer could retrieve a fixed amount of gold. Those receipts were easier to carry than metal, so people started trading the paper itself. The relationship slowly changed. At first, the note represented trust in gold. Later, it represented trust in the institution guarding the gold. Banks discovered they could lend some of the deposited metal while most customers continued using paper claims. Credit expanded commerce, but it also introduced fragility. If everyone demanded their gold at once, the promises could exceed the metal in the vault. Modern banking emerged from this tension between efficiency and confidence. Financial panics in the early 20th century strengthened the argument for a central institution that could support banks and stabilize the money supply. The United States created the Federal Reserve in 1913. Over time, the link between dollars and gold weakened. In 1933, during the Great Depression, the Roosevelt administration restricted private monetary gold ownership and ended domestic convertibility. International convertibility survived in a modified form after the Second World War. Then, in 1971, President Richard Nixon suspended the dollar's conversion into gold for foreign governments. The modern dollar became fiat money, currency accepted not because it can be redeemed for a precious metal, but because the state recognizes it, taxes are paid with it, and the economy continues to produce goods and services. Fiat currency gives governments more flexibility during crises. It also requires disciplined institutions, because its ultimate backing is credibility. When inflation rises or confidence in monetary policy falls, investors often search for assets outside the ordinary currency system. Gold returns because its supply grows slowly and no government can create it with a keystroke. Bitcoin attracts attention for a related, though very different, reason. Its issuance follows software rules and a predetermined limit. Neither asset is a perfect refuge. Gold has storage costs and can fluctuate sharply. Bitcoin is far more volatile, technologically dependent, and exposed to regulation. Their popularity nevertheless reveals something important. People are not only buying an asset. They are buying an alternative story about trust, one based on physical scarcity, or one based on transparent digital scarcity. Trust in money is connected to trust in the economy. In the United States after the Second World War, productivity, wages, and household prosperity rose together for many workers. A single factory income could often support a family, and government-backed mortgages helped millions buy homes. Most children could reasonably expect to earn more than their parents. By the 1970s, inflation and housing costs were beginning to apply pressure, even as more women entered paid work and household income grew. During the 1980s and 1990s, the pattern changed more clearly. Productivity continued to rise, but typical real wages grew much more slowly. Executive compensation and the incomes of the highest earners accelerated. In the 21st century, younger workers often face familiar wages but dramatically higher costs for housing, education, healthcare, and childcare. Economic growth did not disappear. Its rewards became less evenly distributed. The American dream shifted from a common expectation toward a more expensive and uncertain competition. Annual income can describe 5 completely different realities. At $25,000, a security worker may spend more than 40% of income on rent, depend on an aging car, and have no meaningful emergency fund. One repair can become credit card debt. At $40,000, an event coordinator can afford the basics and somewhat better food, but may finish each month close to zero. A medical bill can still become a crisis. At $100,000, a professional may enter the upper middle class. A mortgage or condominium, a newer car, retirement contributions, and occasional travel become possible, depending heavily on location. At $1 million, money begins to buy time. Cleaning, delivery, private services, and professional advice remove everyday friction while investments compound in the background. At $25 million, income may arrive mainly through ownership rather than wages. Homes, aircraft, companies, and charitable structures become tools for managing both lifestyle and taxes. The difference is not merely how many products each person can buy. It is the amount of risk, time, and future opportunity that money can control. Poverty can also become a market. Since the 1980s, parts of America's welfare system have increasingly relied on private intermediaries to process benefits and deliver services. This can add expertise, but it can also create incentives that conflict with the needs of recipients. Complex tax credits may attract preparation fees and costly short-term loans. Subsidized housing can be exploited when rents charged to public programs exceed local value. Contractors paid to manage health benefits may improve margins by reducing staff, delaying applications, or removing eligible people. Medical providers can be rewarded for the number of procedures rather than the health of the patient. Dialysis centers receive reliable payments for repeated treatment, while transplantation may end that revenue stream. Agencies have even been criticized for redirecting benefits intended for foster children or people with disabilities. Not every provider behaves this way, and many public-private programs deliver essential help. The structural danger appears when profit depends on complexity, denial, or keeping vulnerable people trapped inside a billable system. Consider the journey of a tomato. It may be picked on a farm in Mexico, cooled, graded, packed, loaded into a refrigerated truck, inspected at the border, moved through warehouses, and finally placed on a supermarket shelf in the United States. The trip can take more than a week and requires precise temperature control at every stage. Fuel, labor, packaging, refrigeration, insurance, and wasted produce all influence the final price. A pandemic, war, drought, flood, plant disease, or transportation bottleneck can raise costs across the chain. This is real supply chain inflation. The modern food system is efficient because it coordinates thousands of specialized operations. That efficiency also makes it vulnerable, because a shock at one link can move rapidly through every link that follows. But supply shocks do not explain every price increase. During periods of public confusion, powerful companies may raise prices by more than their costs have risen. Economists and journalists sometimes call this greedflation. The term is controversial because profit, demand, and genuine shortages are difficult to separate. Market structure matters. When only 2, 3, or 4 corporations dominate beef processing, pasta, tuna, eggs, or grocery retail, consumers have fewer alternatives and price competition weakens. A temporary shortage can become a convenient explanation for a lasting increase. Output may recover while prices remain high and profit margins expand. Inflation can therefore contain two stories at once: a real disruption that raises costs, and concentrated market power that determines how much of that increase reaches the customer. At the top of the wealth pyramid, money follows different rules. Someone worth $100 million may avoid selling appreciated shares and instead borrow against the portfolio. Loans provide spending cash without immediately creating taxable capital gains. This strategy is often summarized as buy, borrow, die. At $1 billion, wealth can support superyachts, private aircraft, sports teams, and major political donations. Assets may provide prestige, influence, and favorable tax treatment at the same time. At $100 billion, personal wealth can exceed the economy of a small nation. It can purchase global communication platforms, fund enormous technology projects, build private survival compounds, and shape public policy. Trusts and inheritance rules can transfer control across generations, while unrealized gains may never be taxed in the same way as wages. At this scale, wealth is no longer mainly about comfort. It becomes infrastructure, the ability to control time, information, institutions, and the choices available to everyone else. Gold, paper money, wages, welfare, food prices, and billionaire fortunes may appear to be separate subjects. They are connected by one question: who is trusted to define value? Gold turned collective belief into a durable metal. Banks turned metal into paper claims. Governments turned paper into fiat currency. Modern markets turn ownership, credit, scarcity, and political power into radically different lives. Money is one of humanity's most effective inventions. It allows strangers to cooperate across continents and across time. But it is not neutral. Every monetary system distributes risk, opportunity, and power. The most important question is not simply how much money exists. It is who creates it, who receives it first, and what kind of future the rest of society is asked to trust.